Hello and welcome to Fidelity Connects, a Fidelity Investments Canada podcast connecting you to the world of investing and helping you stay ahead. Today on the show, we are joined by Director of ETFs, Andrei Bruno, as he dives into exciting new developments in our ETF and alternative investments lineup. He discusses the expansion of our 4 new ETF series, the Emerging Markets Fund, the Global Equity Plus Balance Fund, the Global Equity Plus Fund, and the Tactical High Income Fund. These new products will bring options to investors looking for more choice and access. Following the latest trends in mutual funds and ETFs, Andrei discusses trade-offs advisors may face, looking at fee structure, fund volatility, and diversification potential. He also identifies the target market for each of the funds in the series and how they are integrated in the mandated investment strategies. Andrei also talks about the all-in-one exposure regions and its users and how it works in relation to the new ETF series and the opportunities it brings. This podcast was recorded on May 23rd, 2024.
Welcome. Great to see you.
Thank you. Always a pleasure, Pamela.
A delight to have you here. Actually, you were at the TSX yesterday.
That's right. We rang the closing bell with the introduction of our 4 new ETF series that we did launch on the Toronto Stock Exchange yesterday.
Okay, so if you're watching on television, you might have seen them there. Now you see them here. If you go back a little bit to sort of the very beginnings, Fidelity was more of an equity long-only shop. That's sort of the legacy. There have been lots of innovations since then. Paint us a picture a little bit about how we got to this point.
Yeah, so it's a great question. Obviously, as you mentioned, historically, Fidelity's been known as, kind of a long-only equity shop, mutual fund shop, I should say. Yeah. Obviously, our lineup has grown and is much more diverse nowadays. So, we've since expanded into exchange-traded funds, into alternative investments. As we know in the alt space, not just long-onlys, we do have long-short mandates. So playing on the other side of the ledger in terms of equity positions there. So, if we think about ETF specifically, we launched the franchise in 2018 with our factor lineup, started with our dividend factor.
Right.
We've since expanded to, 5 different factors as well. And just to take a minute to talk about the factors as well.
Let's do that, because they can be the building blocks, and also, anyway, it's interesting. Yeah, how does this all fit into the way you design it?
Yeah, so when folks think about factors, we think about smart beta, a very quantitative approach as well. So we're also known as kind of a fundamental shop, but we actually have a long history in quantitative research as well. I think we hired our first quant back down at FMR sometime in the 60s. So we have, several decades in terms of quantitative experience on the quantitative investing side. So again, we do leverage our quantitative investing team down at FMR who helped us develop the indices that do underpin our particular factors. And I think you brought up an interesting point there just with regards to how they serve as building blocks. So, at the outset of launching our ETF franchise, what we had in the back of our minds is, how can we build, a balanced multi-asset product in the future? So a lot of these factors underpin our all-in-one suite, which we launched several years after the initial launch of our ETF franchise. In addition to that, we have built out our fixed income suite as well on the ETF side. So we do have 4 mandates on that side as well, and a couple of those mandates are Global Core Plus mandate as well as our Canadian Systematic Bond ETF also underpin those all-in-one mandates. So for those folks who don't know, we do have 4 all-in-one products: our all equity product, our balanced product, and our growth, and our conservative. So our Fidelity all-in-one suite.
Right, and they put those all together, as you say, with a more balanced approach and other approaches as well. So these ones that you've launched just in the last 24 hours, take us through sort of a little bit about them, and then we'll go to sort of perhaps who they're for ultimately, or if someone's looking for this. So let's begin a little bit just going through a couple of mutual funds in there as well. We're focusing on the ETF. So let's go to the Global Equity Balanced, if that's all right. We'll kind of take us into this. This provides obviously a balanced approach. Let's begin there.
So the Global Equity Plus Balance, so it's a new kid on the block in terms of a fund as well. So we concurrently launched the mutual fund and the ETF series at the same time. So in terms of this balanced product, it was kind of building on the success of the Global Equity Plus mandate, which we launched several months ago. A lot of the feedback we got from the market after we launched that is, it would be great is if we could find this in a balanced solution. We love what's happening on the equity side in the Global Equity Plus, but as a one-ticket solution, we love some fixed income in there. So we took a couple of our more popular managers, Jeff Moore, Mike Plage, who managed the multi-sector bond, and then Ford O'Neill, one of his mandates as well. So we put that in there to add to that diversification and provide that multi-asset one-ticket solution to clients.
So let's just go into the global equity. You've got 3 fund managers in there, and then this is also the balance that you talked about. Let's talk about sort of their mandates.
Yeah, so the Global Equity Plus, I think it was our fastest growing fund to reach $1 billion and subsequently fastest to reach $2 billion in AUM. So we do appreciate all the support from our clients out there. So underpinning that particular mandate, there's actually 3 managers, 4 funds that underpin that particular mandate. So we've got our Global Innovators, managed by Mark Schmel. As we know, Mark Schmel is, I don't think he calls himself a growth manager, but he certainly has a growth tilt to his investing style. I'm sure many of the folks online are familiar with Mark Schmel's mandates, but he, as the name suggests, Global Innovators, he's playing in the more growthier, more tech areas of the market. And then, to contrast Mark Schmel, we've got Dan DuPont, who's, as we know, Canadian Large Cap Fund is the fund that's included in Global Equity Plus, and Dan is more of a value manager. As Dan likes to call himself, the most patient man on earth, doesn't like to overpay for stocks. So those 2 mandates obviously balance each other out quite well. When value is working and growth isn't, and vice versa. So it starts to balance one another out. And then finally, and also included in is another one of Dan's mandates is a global value long short. Yeah. So again, a value mandate, global exposure. Again, what that particular mandate brings to the table is the downside protection as well. So, if we rewind a couple of years when equity markets weren't doing so well, and you take a look at what Dan's Global Value Long Short Fund was able to do when markets were going down, provides some good downside cushion there. Finally, we've got Hugo Lavallee, who's a self-styled contrarian investor. So he's, I like to say he's kind of the salmon going against the stream. When everyone's hating stuff, that's the areas of the market that he's looking for to try to find value. So what the great part about this mandate is we bring them all together. Yep. And if we take a look at kind of, how they all interact with one another and how these funds interact with one another, what we've noticed is from a risk-adjusted return perspective, we've noticed that it's been greater than any individual manager. The other benefit here is, let's say value is doing well or growth is doing well, it takes away that need from the investor to say, okay, I need to pick Dan right now or Hugo right now. And again, all the rebalancing is happening under the hood for you as well.
So you've got that great mandate that you just described, 3 managers. Then you've got the balance piece of it, which is bond mandates within that. So that's a new to ETF, offered as a new ETF. Let's go on to some of the other ones. So we'll kind of circle back to that. One of them is an emerging markets mandate, which I think, again, we've spoken to some of the managers before, but now offered in this particular way. Tell us a bit about that.
My personal opinion on emerging markets is, emerging markets is kind of this catch-all term for
it really is.
Everything.
What's it mean?
Everything that isn't kind of a developed market is emerging markets. And, they're all lumped together, but, all the individual emerging markets do not necessarily share the characteristics with one another. There's a lot of idiosyncrasies with every different country, their geopolitical situation, the structure of their market, their, whether or not they have capital controls, what have you. All that to say is, there's a lot of inefficiency in emerging markets. There's not certainly a lot of eyes on the individual names in emerging markets. You think about the S&P 500, like there's 1 million people, your brother and your mother, who are looking at Apple and knowing what's going on. So, there's certainly some informational asymmetries in emerging markets, but with that there's a lot of opportunity. And so I think that's where active management can really shine, is in those types of markets where there is a lot of inefficiencies. So Sam Polyak runs our emerging markets funds. I believe there's something, somewhere around over $5 billion of AUM, could be a little higher, somewhere around that number. So he's done a tremendous job managing that fund. And, we're conscious that there are market participants who do like to get that targeted exposure to emerging markets. And we want to expand the accessibility of this mandate into the ETF vehicle. So that's what we've done here. Again,
that's great.
We think it's one of the areas of the market where active management can really shine.
And then we've got the tactical high income fund. So this is taking a look at where you're getting something and you can pay the rent with it. That's sort of the general idea as an ETF. So tell us about that.
So as the name would suggest, it's an income-oriented mandate.
Yes.
No surprise there. Managed by Adam Kramer, who's done a tremendous job. This particular mandate has been really resonating with clients over the last couple of years. So, it's a multi-asset mandate, so playing both in the equity and the fixed income space. It's relatively unconstrained in terms of an asset allocation perspective. It's a very tactical mandate, again, as the name would suggest.
Yep.
Adam is able to find kind of wherever there's value, right? It kind of can go anywhere with regards to equities or fixed income, can play with prefs, levered loans, wherever he sees the opportunity set.
Preferred shares.
As part of his approach, he's balancing kind of, the income aspect with the risk as well.
Okay.
So, obviously you don't want to go chase yield, and, sometimes things are high yielding for a good reason.
Exactly.
So he's able to balance that and take a tactical approach to try to drive, returns, whether it's on the income side of the ledger or just the alpha side of the ledger. So again, it's been a great mandate. It's a good mixture between fixed income and equity, so you do get the diversification factor, but it is an extremely tactical mandate. And again, Adam's done a tremendous job managing it.
And then we'll circle back to the ETF series of global equity, which is kind of what we started out talking about, but in a balanced form. Just circle back to Global Equity Plus as an ETF.
Yeah, so Global Equity Plus, in terms of all these mandates, I'm going to broaden it out a little bit in terms of why we brought these markets as well. I know we talked about the individual mandates and why we selected those ones, but to talk about, why we're expanding into ETF series, a lot of people are like, it's already in a mutual fund. Why are you bringing it to an ETF series?
Why are you doing that, for sure?
We kind of started down this path last May when we launched our first ETF series on a handful of mandates as well. Most of the funds that are in Global Equity Plus, we actually launched with the addition of our global small cap, managed by Connor Gordon, Chris Malodzinski, a great mandate as well. I would recommend taking a look at that. They've done a great job there. So again, we just want to expand access to our fund suite. We have over 150 mutual funds, approaching, I believe, just somewhere over 50 ETF tickers now. So again, it's more of an access play. We want to give investors choice. There's some investors out there who prefer ETFs, some who prefer mutual funds, some who use a mixture of both. Ultimately, we are agnostic here at Fidelity with which vehicle that you prefer, whatever works best for your practice or your investment style. We simply want to provide the market choice, and we are vehicle agnostic here at Fidelity.
What is the difference? A lot of people know the answer to this, but we're going to ask you anyway.
Yeah, so it's fairly straightforward, to be perfectly honest. It isn't a long and convoluted answer. So, ultimately, as we know, mutual funds, you kind of put your ticket in, you get filled at 4 p.m. NAV that day. ETFs trade on exchanges just like stocks, so you do get that intraday liquidity. One potential benefit, and it depends on the dealer and kind of where you trade, but often it can be a little bit easier to bulk trade ETFs relative to mutual funds. So there is that added benefit there. So I literally just break it down to those two benefits. Again,
Fantastic.
Some people prefer the mutual funds, some people prefer the ETF, but now we're just trying to give folks the choice.
Other than automated transactions, what reason would an advisor choose the mutual fund series over the ETF, given the reduction in fees on the ETF versions? So just follow it up.
So in terms of the fee structure, actually, our ETFs series are priced similarly, almost exactly the same. Obviously, HST can affect kind of the series level MERs, but in terms of the overarching MER, our ETF series are actually going to be, should be very close, if not the same, to the Series F. And the reason there is we did solicit a lot of feedback from the dealers, and they essentially said, these are the same products, they should be priced similarly. To answer that question, it really comes down to the individual investor. Like I said, some people do value that intraday liquidity and that ability to bulk trade. And again, some shops have kind of automated and made it a lot easier to bulk trade mutual funds, so it may not apply to you necessarily. So I'd say, honestly, those are the only two reasons. So whatever works best for you. Again, we're agnostic. You're getting the same pool of assets, same asset manager, same mandate under the hood. It's literally whatever works best for you in your practice.
When you look at any of the trades about the mutual fund industry and so on, there's a very clear and distinct flows story, isn't there, about mutual funds and ETFs? Just take us through sort of the latest on that. A lot of people are looking at ETFs these days, and that's basically the story. Yeah,
so we think about last mutual funds, I believe were in net outflows last year, where ETFs had a fairly strong year. So I think it's a function of just industry adoption. I think just more people are starting to utilize ETFs a little bit more in their practice. If you think about, we often look down at the United States and take a look at the trends that are transpiring there, and we're typically 5-10 years behind. They've certainly been going through that down there. You're seeing some manufacturers down in the United States convert some of their mutual funds into ETFs as it's starting to become a little bit more dominant with regards to more of a dominant vehicle than it historically has been. And I think we're seeing that slowly in Canada. That being said, I don't think we're going to see mutual funds going anywhere anytime soon. I think they still have a place in the market, and they're still a very important investment vehicle. But I think we're just starting to see folks adopt ETFs more and more as time goes by.
What other trends are there? This is what you do every day. You watch this very, very closely. What trends would you point to within ETFs?
Yeah, so generally longer term trends, which also kind of, is one of the reasons we've been expanding into the active ETF space as of late as well, is we've been seeing active ETFs grow at a faster clip relative to kind of the passive or the smart beta. So we're talking about growth rates here, not total flows.
Yeah.
Passive still takes in the lion's share of flows. So also one of the reasons again why we have been expanding into the active space with regards to our ETFs. If we think a little bit more shorter term in terms of what we're seeing, one big trend has been kind of the reversal of kind of the HISA ETFs. So last year,
high interest savings,
high interest savings accounts. That's right. So last year there was somewhere around 40 to 50% of all flows into fixed income was into kind of the shorter term space, and a lot of that going into the HISA space. So
the spike in interest rates just made it sort of a really good option for a lot of people.
The rates were more attractive relative to money markets, so it was a no-brainer. I mean, there was very little counterparty credit risk in terms of obviously you're facing the banks underlying in the funds, but no duration and higher yield. So a lot of the money was flowing there. OFSI has since come back because they were doing a review of these products, and not to get into the weeds too much, but essentially they were taking a look at the banks who were taking these deposits and saying how are they treating them? Are they treating them as retail deposits, or are they treating them as institutional deposits?
Right.
Why that matters? Why does anyone care? Retail deposits are treated more favorably from cash coverage ratio perspective relative to institutional. Long story short, they said can't treat them as retail deposits. Yeah. So what we've seen as a result is a lot of the yields have come down on those HISA ETFs, and they're getting a lot more competitive relative to the money market. So
the flows story from there is?
Yeah, I believe they're in outflows for this year.
Yeah.
We have started seeing some of that money just go into traditional money markets. Mm-hmm. We've also been seeing some of it go into slightly longer duration products. Obviously, if you think about Canada, the prospects of a rate cut seem to be a lot higher relative to, let's say, the US. I think, markets are pricing in cuts from both sides of the market. My 2 cents is I think it'll be tough for the FOMC to cut rates given that inflation is still above their 2% target.
You're a bond guy. Hang on. You started out with the bond desk. Let me just ask you a couple of things about here. Okay. All right. So the duration story in Canada to the US is very different, yes? We think?
I think your risk in the U.S. is, there is some scenario where you could see kind of rates from the 3 out to 10 continue to move high. They have moved higher this year.
They have, yeah.
If you take a look at the U.S. yield curve, 3s out to 30s is, upward sloping. In Canada, we've still got that downward sloping curve. So to me, it says the bond market is saying, I'm not sure we're going to get a recession in the U.S. this year. In Canada, it's saying, I still think we're going to get a recession.
That's looking more likely here.
So and you overlay the macro headwinds with the Canadian consumer and all this, and there's certainly scenarios where we're going to see some rate cuts this year. How many is anyone's guess? We just printed, I think, 2.7 or 2.8% inflation. Just to remind viewers, we actually have a band in Canada, a target band, 1 to 3%. So we're technically in that band.
Yeah, who did you just interviewed yesterday? Oh, was it David Wolf said a lot of Canadians don't know that we have a range, and in the U.S. they're kind of like, that's nice. It's nice you have a range. You don't have to hit 2%. It's kind of nice to have a range.
Well, and all that to say is we're technically in the range.
We're in the range.
So if we do see GDP print negative, there certainly is an impetus there for them to say, hey, it's time to cut rates. Our consumers are extremely sensitive to interest rate changes, both because of our mortgage market and because of our consumer debt levels. To contrast that with the Americans, their mortgage market is very different. Most mortgages are 30-year termed. Their consumer have a little less debt, good amount of less debt than we do, although those are starting to tick up as everyone's kind of gone through all their COVID savings on both sides of the border. So, if I was a betting man, I would say I think we'll see some cuts out of Canada this year. I'm not sold that we'll necessarily see some cuts out of the BOC.
Yeah.
All that to say is Canadian fixed income, maybe you can get some cap gains on the duration play in Canada. Not so sure on the U.S.
Maybe paid to wait in this story a little bit. In the U.S. story a little bit. Okay, so let's go from everything that you've just said. Take us through different investors, they might have very different tolerances for risk, for instance. They might be at a different stage in their savings. Of the funds that we've launched today, how might they work in this particular market environment? Like, let's sort of go to the Global Equity Plus. Let's begin there as an ETF. You explained the managers that are in there. I mean, we got some earnings out last night that obviously work very well with the growth mandate part of that story.
NVIDIA investors are happy.
They're happy. But as you say, like around the corner, we're not sure exactly. So perhaps the other things come to bear. So who might this work for?
Yeah, certainly. So, obviously, the easiest comparison is Global Equity Plus and Global Equity Plus Balance. So obviously
So let's go there.
The only variable there is if you're looking for some fixed income allocation. Obviously, risk tolerance, horizon of investment comes into play, big time here, of course. If you are looking for more of a balanced solution, it's a 55-45 in Global Equity Plus Balance, roughly, is what the initial weight. Obviously, it's going to move around with market movements, of course. Obviously, that's for an investor who's looking for more of a balanced mandate, needs that fixed income in there to dampen the overall volatility of the portfolio. Obviously, those who might have a slightly higher risk tolerance, your Global Equity Plus, pure equity mandate, ticks that box for you. Yeah. Also, EM as well. Obviously, as we know, emerging markets can be tremendously volatile. A lot of opportunity, but with opportunity comes risk as well. So, for those who are looking for a little bit more, a little bit more volatility, but a little more opportunity, a little bit higher risk. Obviously, EM fits that bill. Yeah. Tactical high income,
Can that work in a lot of different markets?
Yeah, absolutely. If you think about the overall kind of volatility of this thing, it's not in the high risk bucket for sure. Right. It is a little bit more tactical. But again, I think Adam Kramer runs it in a very risk is obviously very top of mind for him. So again, it's another sits somewhere in there in the roughly balanced category. That being said, it can move around quite a bit, so that's something to consider. Obviously, if you have strict need to keep X% in fixed income for a particular client because they're in a very low risk bucket, perhaps that might not be the best solution because he can move around, he can move that around. The equity allocation can go there or go there. So something to consider if you are taking a look at that particular mandate.
Yeah, and the income story is just really attractive to a lot. I was told recently that Canadians love dividends, like more than I guess lots of people love dividends, but we seem to particularly love dividends and just income.
We do. We have noticed that in the marketplace for whatever. For whatever reason.
Do you have a reason for it? What is that?
I can guess.
Okay, guess. Just for now,
if I had to guess, I think we are a little bit more conservative than say, for example, our neighbors to the south. So dividends and income is inherently a little bit more of a conservative investment. But we do see that a lot. Canadians do love their income. You see a lot of money flow into income-related mandates. You do see some divergences in terms of flows with us relative to the U.S. Sometimes we've got our dividend factor is doing well for some reason in the U.S. No one's buying dividends. So I just think that's just how we invest in Canada and how we are.
Okay.
That's my 2 cents anyway.
Yeah, no, I think it's interesting, and yeah, that was sort of what I gathered as well, that we just kind of like them. These different mandates that we've discussed today, you've also got the all-in-ones, which include everything, and again, have a tilt to a more balanced or something regional, for instance. Again, who might those be useful for as they relate to the ones that have just been launched today? They'll ultimately be included? Is that the idea?
Yes, so the all-in-ones, that's a good question. We kind of span the kind of gambit of, all equity all the way down to conservative mandates.
For the all-in-ones.
That's right. Yeah. So it really, again, this ties back to, risk tolerance, investment horizons, and kind of what you're trying to achieve. What's underpinning all of those mandates, as we mentioned earlier, alluded to earlier, is 4 of our factors. So we've got our momentum, our low vol quality, and our value factors, which is underpinning the equity, the lion's share of the equity position. We also have some active in there as well in our global small cap, as I mentioned earlier, managed by Connor and Chris. So you do get some of that exposure in this as well. On the fixed income side of the ledger, we've got our systematic Canadian bond and our Global Core Plus managed by Jeff Moore and Mike Plage there. So again, you've got your 60-40 on the balanced, all the way up to your full equity, sleeve, as well as your conservative, where you're getting, lion's share is going to be held in that fixed income. But again, these product suite has been, it's resonated very well. It's probably our number one selling suite this year.
Yeah, it's all over the newspapers. You always see it, if you're flipping through something and online, it's always there.
So, the performance has been there. It's been doing tremendously well. It's doing what we expected it to, what we wanted it to. From a fee perspective, it is relatively low fee. So coming in at a very competitive fee levels as well. So again, as I mentioned, it's really been resonating with clients. It's been our number one selling suite this year. So again, there's kind of something in there for everyone, depending on kind of what you're looking for.
Sure.
To pivot a little bit as well and rewind back to our January launch, we also launched our regional all equity ETFs as well.
Good. I'm glad you mentioned these. Yeah, because this is really interesting. Who would want a different approach exposure to different regions?
Yeah, so a lot of the feedback we got is, we obviously launched these all-in-ones, and we launched the all-equity all-in-one, which is, for all intents and purposes, is a global mandate.
Right.
I should say international mandate, rather. There's no U.S., or there is U.S. in there, so it's U.S., North America, kind of everything in there. But the feedback we got from the clients is I really like this, I like the factor story, but I'd like to get just kind of targeted geographic exposure. So essentially what we did is we took those equity factors and we just bundled them based on their international, or based on their geography rather. So we've got our Fidelity All Canadian, our Fidelity All International, and our Fidelity All American. So again, bundling the momentum, low vol, quality, and value into their geographical flavors to get targeted exposure. One thing that we were thinking about when we put these together as well, and we were thinking about in the back of our minds is, if we think about kind of market cap weighted indices.
Right.
So
okay.
they've got their benefits, but they've got their downsides. As well as the winners continue getting bigger and bigger and bigger and bigger, and your exposure to those winners keeps on getting bigger and bigger and bigger. So, we were looking for something that was a little bit more diversified in there, not quite going all the way down to kind of the equal weighted, where you're just kind of buying, the top, the bottom 50 in the S&P often get bumped out of the S&P as well.
It's really interesting. Yeah.
So we were trying to look for something that was kind of a happy medium, and combining our factors together does achieve that. So we were looking for something that might be a little bit more diversified than the cap weighted indices, but a little bit more concentrated than the equal weighted. So again, they've been
real active in there. I mean, that's sort of an interesting approach.
Well, like we say to our factors, are active in design, passive in implementation.
Right. Okay.
Is how we
active by design. Yeah. That's good. So what do you want everyone to know as we sort of close out? So you've been to the TSX. This is now available. What do you kind of want to roll back and just make sure everyone knows about these 4 funds that have been new ETFs?
Yeah, I mean, I think I'll talk about the lineup broadly speaking. Yeah. Like I said, we launched the business back in 2018. We've since expanded over to 51 tickers, spanning alternatives, crypto, multi-asset, bonds, sustainable ETFs as well. We're committed to expanding the lineup, bringing more options to our investors, whether that's converting or launching ETF series off existing mutual funds, playing in spaces that we aren't currently playing in. But we've been really focused on broadening out the lineup and having a solution for whatever the client's needs might be. Fantastic.
There's a final question here. So positioning, why is there currently a 56% allocation to Canadian equities for a global ETF? This is the Fidelity Global Equity Plus ETF.
Yeah, so that's a good question. So if we think about two of the mandates in there, Greater Canada and Canadian large cap.
Yep.
If you take a look at kind of under the hood and what they're kind of, because they need to have at least 51% Canada in each of those funds.
Makes sense. From the title.
So adding those together, that's and if you think about the global value long short, there's going to be some Canada in there as well. So that's where it's shaking out to having. I can't spepe to. We'd have to ask Hugo and Dan
why
specifically, but naturally you're going to have. You're going to have some Canadian exposure in there just based on the underlying mandates.
Yeah, I think we're speaking to Hugo soon along this. Great to see you, Andrei. Congrats on all of this, and thank you for joining us and taking us through what's been launched and what's available.
Thanks so much, Pamela. Always a pleasure to be here.
All the best.
Thanks for listening to the Fidelity Connects podcast. If you haven't done so already, please subscribe to Fidelity Connects on your podcast platform of choice. And if you like what you're hearing, leave a review or a 5-star rating. Fidelity mutual funds and ETFs are available by working with a financial advisor or through an online brokerage account. Visit fidelity.ca/how-to-buy for more information. While visiting fidelity.ca, you can also find information on future live webcasts. And don't forget to follow Fidelity Canada on Twitter and LinkedIn. Thanks again. See you next time. The views and opinions expressed on this podcast are those of the participants and do not necessarily reflect those of Fidelity Investments Canada, ULC, or its affiliates. This podcast is for informational purposes only and should not be construed as investment, tax, or legal advice. It is not an offer to sell or buy or endorsement, recommendation, or sponsorship of any entity or security cited. Read a fund's prospectus before investing. Funds are not guaranteed. Their values change frequently, and past performance may not be repeated. Fees, expenses, and commissions are all associated with fund investments.